am CA Neeraj B. Welcome to my YouTube channel Accounting Buddy. Today we are starting a very important chapter, that is accounting procedures, rules of debit and credit, which is the very foundation of double entry accounting system. In this chapter, we will learn in detail meaning of the term account, meaning of debit and credit, rules of debit and credit, classification of accounts, the concept of balancing an account, and significance of debit and credit balances in accounts. So sit back, relax, and watch the full video. Learning the rules of debit and credit is going to be a game changer in your journey of learning accounting. In part 1 of chapter 6, Accounting Procedures, Rules of Debit and Credit, we are going to learn 11 topics along with examples, followed by question and answer session, which will cover the question and answers related to the rules of debit and credit, their applications, MCQs, and true and false question and answers. Let's get started. Let us start with a recap. Business transactions are recorded in the books of accounts on the basis of the source document. Source documents such as purchase invoice, sales invoice, debit and credit notes are the evidence that the transaction recorded in the books of accounts is genuine. Rules of debit and credit are applied to each transaction and they are recorded in the book of original entry, that is the journal book, or special purpose book like sales, purchase, cash book, etc. All the transactions are recorded in a chronological order, date-wise, and in the sequence of their occurrence. The transactions recorded in the journal book are then posted to the specific account maintained in the ledger. Every business is set up with an objective of making profit. Every business enters into numerous business transactions like sales, purchase, expenses, payments, and receipts, etc. to conduct the business. In order to find out the profit earned or loss incurred, the business needs a system. Therefore, the accounting, which is also known as the business language, was developed. Accounting is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating financial information. Seven-step process of accounting is displayed on your screens. Let us understand these steps with the help of a flowchart. Step 1. Identify business transactions and events which are financial in nature. Step 2. The business transactions so identified must be measurable in monetary terms. Step 3 is the recording of the business transactions which are identified and which are measurable in monetary terms in the books of original entry, that is the journal, or in the subsidiary books like cash book, sales book, and purchase book. Step 4 of classification is a process of recording or posting similar transactions at same place under one account in the ledger. Step 5 involves the activity of summarizing all the business transactions so recorded in the form of financial statements, that is trial balance, profit and loss account, balance sheet, and cash flow. Step 6. Under this step, financial data is analyzed and interpreted so that the user of the financial data can make a meaningful assessment of the financial performance and financial position of the business. Step number 7 is the process of communicating financial data to all the stakeholders, whether internal or external. Let us now first understand the term account. In accounting, an account is a record in the journal ledger that is used to sort and store business transactions. It is a record of the same type of transactions entered into by the business within an accounting period under a particular head of account. Since the business enters into several type of transactions, for each type of transaction, there will be a separate account in the journal ledger. Each account not only records the amount of individual transaction related to the respective accounts, but also their accumulated balances and their effect on the business. For example, the business will have cash account. In cash account, all the transactions that increases or decreases business cash are recorded. Similarly, sales account will record all the amounts related to the sales of the goods. I hope we have understood the term account and its relevance in accounting. Also, always remember, under double entry accounting system, every transaction will always affect two accounts. One will be debited and another will be credited. For example, cash sales will increase the cash account and will also increase the sales account. An account is divided into two parts, debit and credit. An account is represented in T form. The T account is a visual representation used in accounting to depict the individual accounts and their balances. It gets its name because it's T shape where the account title is written at the top and the two columns are created. One for debit, which is the left hand side, and one for credit, which is the right hand side. T accounts are useful for teaching basic accounting principles, analyzing the effect of transactions on individual accounts, visualizing how the debit and the credit affects the financial records. T accounts helps in understanding how the different transactions impact on accounts balance in a straightforward manner. Let us learn about the T account format and the information which is captured for each transaction in a particular account. There are four columns on each side of the T account. They are date, particulars, journal folio and amount. In the date column, the date of the transaction is mentioned. In the particulars column, the name of the other account is mentioned. In the journal folio column, the page number or the reference number of the journal book or the subsidiary book is mentioned where the entry was first recorded. And in the amount column, the amount of the transaction is mentioned. Left hand side of the T account is the debit side, and similarly four columns are there on the right hand side of the T account, which is the credit side. Remember, if a transaction is affecting the debit side of an account, the details will be filled on the left hand side of the T account, and if it is affecting the credit side of an account, the right hand side of the T account will be filled. Further, the name of the account is mentioned on the top of the T account together with the period for which the transactions are recorded in a particular account. To sum up, below mentioned points should always be remembered about T account. Name of the account along with the period is mentioned on the top of the T account. Account is divided into two identical halves. Left hand side is called the debit side. In short, it is written as DR. Right hand side is called the credit side. In short, credit is written as CR. Now, depending on the effect, an entry will either be written on the debit side or the credit side of an account. Let us understand the term account with an example for cash account for the period 1st April 24 to 30th April 24. As we know, cash is an asset of the business and assets when increase are debited and when they are reduced they are credited. On left hand side of an account we have four columns, that is date, particulars, journal folio and amount. Left hand side of an account is debit side and is denoted by the two letter word DR. Similarly, on right hand side of an account we have four similar columns. Right hand side is the credit side and is denoted by the two letter word CR. As a result of a business transaction, if the assets increases, the asset account is debited, and if the assets decreases, the asset account is credited. Therefore,
all the business transactions which will increase the cash balance are recorded on the left hand side of the cash account, or in other words are recorded on the debit side of a cash account. Now in the given illustration, we have an opening cash balance of 50,000, and during the month of April 24, business has received cash from sales of goods 75,000, collection from debtors 80,000, commission of 20,000 is received, advance of 15,000 is received from the customer, cash received from the resale of an old vehicle is 40,000, and the capital of 100,000 is contributed by the owner. Now on debit side of the cash account, with opening balance of 50,000 and after adding all the cash amounts received during the period of April 24, the total value is 380,000. Now during the month of April 24, the business has paid several business expenses payments as displayed on your screen. Staff salary 80,000, rent 40,000, cash purchases 50,000, payment to creditors 60,000, withdrawal by the owner 20,000, cash deposited into the bank 75,000. All cash outflows are recorded on the credit side of the cash account. Now, if total outflow of cash is deducted from the total of 380,000, the business will left with a closing cash balance of 55,000. Let us understand more about the terms debit and credit. Debit and credit are the two sides of the same business transaction. Debit refers to the left hand side of an account, while the credit refers to the right hand side of an account. In the abbreviated form, DR stands for debit and CR stands for credit. An amount of a business transaction recorded on the debit side of an account is said to be debited to that account, and an amount of a transaction recorded on the credit side of an account is said to be credited to that account. Both debit and credit may represent either increase or decrease depending upon the nature of an account. The rules of debit and credit depends upon the nature of the account. Let us understand the rules for assets, liabilities and equity accounts. For asset accounts, when asset increases, the asset accounts are debited, and when assets decrease, asset accounts are credited. For liability accounts, when liabilities decrease, liability accounts are debited while they are credited when the liabilities increase. Similarly, for equity accounts, they will be debited when equity decreases and they will be credited when equity increases. Now let us understand the debit and credit rule for revenue and expense accounts. Revenue of the business when increases, the revenue account will be credited, while the revenue accounts are debited when the revenue decreases. While expense accounts are debited when expense increases, and expense accounts are credited when they decrease. Memorize this debit and credit rule for 5 class of accounts displayed on your screens. Let us now learn the rules of debit and credit. Under double entry system of accounting, each transaction has two aspects. One aspect is debit, that is receiving or incoming aspect, and another is credit, that is giving or outgoing aspect. Debit and credit aspects of a transaction forms the basis of double entry system. Rules of debit and credit are formed basis of these two aspects in each of the business transaction or event. The following are the rules of debit and credit which guide the system of accounts. They are known as the golden rules of accountancy. First rule is debit what comes in and credit what goes out. Rule number 2 is debit all expenses and losses and credit all incomes and gains. Rule number 3 is debit the receiver and credit the giver. We will discuss these rules in detail with examples in our subsequent slides. Let us learn about the classification of accounts. Accounts can be classified in two ways: traditional classification and modern classification. Traditional accounts are further of two types: personal accounts and impersonal accounts. Now, personal accounts are further classified into three types: natural personal accounts, artificial personal accounts, representative personal accounts. And impersonal accounts are of two types: real accounts and nominal accounts. Now, under modern classification of accounts, accounts are categorized into five types: asset accounts, liability accounts, equity accounts, revenue accounts, and expense accounts. At this stage, please remember this classification of accounts under traditional classification and modern classification of accounts. We will discuss in detail the rules of debit and credit for each class of account in subsequent slides. Under traditional classification of accounts, let us learn about the personal accounts. When a business transaction is entered into with a person, one of the two accounts affected by the transaction is related to a personal account. Person could be an individual, firm, company, debtor, or a creditor. Therefore, an account in which all the transactions related to a person are recorded is called personal account. For example, Mr. Tolly, who runs a sugar supply business, sold 100 kg of sugar to Mr. Polly and 200 kg of sugar to ABC Private Limited on credit. Now, the credit sales transaction is recorded in the personal accounts of Mr. Polly and ABC Private Limited. Both are debtor accounts of the business. Let us take another example. Mr. Tolly purchased 500 kg of sugar from XYZ traders for INR 50,000 on credit. Now, this transaction for credit purchase shall be recorded in the personal account of XYZ traders. XYZ traders personal account is a creditor account for the business. Both capital and drawing accounts of the proprietor are also personal accounts. The personal accounts are maintained to determine the balance due to or due from the persons with whom the business is dealing. Let us now discuss three types of personal accounts: natural personal accounts, artificial personal accounts, and representative personal accounts. First, let us take up natural personal accounts. The term natural person means the person who are the creations of the God. Therefore, these will include accounts in the individual names. For example, business transactions done with, say, Mr. Rowley or Mr. Polly will be recorded in their personal accounts maintained under their individual names. When the business deals with a natural person, an account in the name of the person is opened in the books of accounts of the business to record the transactions and to settle the account. Now let us learn about the artificial person. These accounts include accounts of the other business entities such as firms, corporate bodies, or institutes which are considered as artificial persons in the business dealings. Business transactions done with, say, ABC Private Limited or XYZ Consultancy LLC are recorded in the accounts opened with the names ABC Private Limited or XYZ Consultancy LLC. Such accounts are the examples of artificial personal accounts as they are not natural persons. Let us learn about the third personal account, that is the representative personal account under the traditional classification of accounts. These are the accounts which represents a certain person or a group of persons. Let us understand this with an example. If the rent is due to the landlord, an outstanding rent account will be opened in the books of accounts of the business. The outstanding rent account represents the amount of the rent payable to the landlord. Therefore, outstanding expense account including prepaid expense account
accrued income account, and unearned income account are some of the examples of representative personal accounts. Now the rule of debit and credit is same for all the three type of personal accounts. And the rule is debit the receiver and credit the giver. In this section, we will discuss questions and answers related to fundamental rules of debit and credit. Question number 1 is, what is the basic rule of debits and credits in accounting? The answer is, debit increases assets and expenses, while credit increases liabilities, equity and revenue. Question number 2, how are assets affected by debits and credits? The answer is assets increase with debits and decrease with credits. Question number 3, how are liabilities affected by debits and credits? The answer is liabilities increase with credits and decrease with debits. Question number 4, what happens to equity accounts when debited? The answer is equity accounts decreases when debited. Question number 5, how do revenue accounts react to credits? The answer is revenue accounts increases with credits. In this section, we are going to take question and answers related to the practical application of debit and credit rules. Question number 6 on your screens is, how do you record unpaid wages? The answer is debit wages expense account and credit wages payable account. Question number 7, how is bad debt written off? The answer is debit bad debt expense account and credit accounts receivables. Question number 8, how is a dividend declared and paid recorded? The answer is debit dividend account and credit cash account. Question number 9, how do you record the sale of equipment? The answer is debit cash and credit equipment, and also record if there is any gain or loss in the transaction. Let us test our knowledge through multiple choice questions. Question number 10 on your screens is debit means, and the options which are available are option A, an increase in asset, option B, a decrease in asset, option C, an increase in liability, and option D, an increase in asset or expense. The correct answer is option D, an increase in asset or expense means the debit. Question number 11, credit means, and the available options are option A, an increase in asset, option B, an increase in liability, option C, a decrease in asset, and option D, a decrease in liability. And the correct answer is option B, an increase in liability. Question number 12, how many sides does an account have? The available options are option A 2, option B 3, option C 1, and option D 4. And the correct answer is option A, account has always two sides. In this section, let us address few true or false question and answers. Question number 13 on your screens is sales account is a revenue account and has credit balance. It is a true statement. Question number 14, drawings is a representative personal account. This is again a true statement. Question number 15, an asset account increase is shown on the credit side. This is a false statement. When an asset account increases, it is always shown on the debit side. Question number 16, in liability account, decrease is shown on the debit side. This is a true statement. Question number 17, goodwill is an asset account. Again, this is a true statement. Question number 18, sundry creditor account has a credit balance and is an asset account. This is a false statement. Though sundry creditor by nature always have a credit balance, but it is a liability account. Question number 19, sundry debtor account has a debit balance and is an asset account. This is absolutely true statement. Question number 20, discount received have credit balance. This is again a true statement. In our upcoming video of part 2 in the series of accounting procedures, rules of debit and credit, we will learn in detail about personal, real and nominal accounts and their rules of debit and credit with the help of 3 illustrations. We will also cover modern classification of accounts and their rules of debit and credit together with a question and answer session. If you enjoy the content of my channel and appreciate my teaching style, please like, comment, subscribe and share my channel Accounting Buddy. Don't forget to hit the bell icon so you never miss an update. Thank you and goodbye for now.